For those of you guys who don't know me, my name is Haley Gant. I'm one of our certified IRA specialists here at Quest, and I will actually be teaching today's class all about the health savings account, which is one of 7 different types of accounts that can be self-directed at Quest. And the health savings account is really awesome because it has a lot of great uses, a lot of great tax advantages. So if you have health expenses, like pretty much all of us out there these days, I hope you guys find some useful information in today's class. And if you have any questions, be sure to put them in the Q&A box and we'll be answering them at the end of the presentation. Now, before we get into today's main presentation, I do just have a couple of quick announcements for you guys, kind of as we let people get signed on here. I'm going to let you know about some upcoming legislation changes that could definitely have an effect on Quest, some of our upcoming events, and some promotions that we have going on for you guys as well. So, quick little commercial about Quest. Who is Quest Trust Company? At the core of our business, we are a self-directed IRA custodian. So we basically teach investors and, average people out there how to utilize their old 401ks and IRAs and even health savings accounts to invest into assets outside of the stock market. So where 98% of Americans have their IRAs invested into stocks, mutual funds, and other types of publicly traded assets, at Quest, we think a little bit differently about how you can actually invest these different types of accounts. And our clients self-direct their IRAs into real estate, notes, private placements, and other sorts of privately held investments. Now, we're a pretty good sized company. We're based out of Texas, but we do have clients in all 50 states. We are in Houston, Texas. It's nice and rainy out here today, but if you guys are watching from outside of the state of Texas, we do operate in all 50 states, and a lot of our processes can be done online to make it easy for you guys, even if you're not physically located where our offices are. And last but not least, a quick disclaimer, please be aware that at Quest, we do not give tax, legal, or investment advice. We provide a lot of education, we put on a lot of events, but please make sure you're doing your own due diligence before you enter into investments. These accounts and investments are 100% self-directed. So it does fall on your responsibility as the client to make sure that you're doing that proper due diligence before you enter into your deals. Now, moving right along, this is something that is a really big topic of conversation in our industry right now. If you guys have been following us or following any of the IRA or legislation news out there, you know that there has been a $3.5 trillion budget reconciliation bill that has recently been proposed. It has not been voted on just yet, but it's really important to be aware that some sections in this bill could actually have a pretty significant impact on self-directed IRAs and some of the investments that we're able to hold in these types of accounts. Now, if passed, this bill would basically eliminate IRA-owned trusts and LLCs. And the really big kicker for us is that after the end of this year, you would no longer be able to invest your IRA into any sort of private placement that requires the investor to meet any sort of pre-qualifying criteria, such as you have to be an accredited investor or a sophisticated investor, any sort of pre-level of education. Those would not be able to be invested anymore after the end of this year. And not only that, but any of these private placement investments that are currently held in an IRA would lose their IRA status in 2023. So guys, this is definitely something serious that's out there right now. Again, it hasn't been voted on just yet. So this is our time as investors and as leaders in the industry that we need to make as much noise as possible to our representatives, our district representatives, our senators out there. And I'll have a couple of resources for you guys for that here on the next couple of slides. Now, I'm not going to spend too much time on this. This kind of section on the right is kind of what I just touched on. But, the kind of reasoning behind this bill was they really want to eliminate people from being able to build up tens of millions of dollars completely tax-free in IRAs. So you can kind of see more of the effects of this bill here. If you guys want a copy of these slides, just reach out to us. I'll send them to you. And one really important thing with this bill as well is Roth IRAs and Roth conversions. If this bill is passed the way that it is currently written, Roth IRAs would be severely limited for a lot of individuals after the end of this year. So, guys, I know today we are talking all about health savings accounts, but I do have one piece of advice to offer to you guys today. If you do not currently have a Roth IRA, 100% you need to get one opened up by the end of this year, make contributions if you're eligible to, or anyone at this point in time can do what's called a Roth conversion, where you actually move funds from a traditional IRA into a Roth IRA that now grows completely tax-free. And if this bill passes the way that it is currently written, Roth conversions might be limited for a lot of people, after the end of this year. So we're going to be talking about health savings accounts here in just a few minutes, but I do think it's really important to stress this to you guys. If you don't have a Roth IRA open, get one open and get money into this account before the end of this year. And last but not least, as far as the legislation goes, this website right here is a fantastic resource for you guys. This is handsoffmyira.com. This is not a website that Quest has created, but if any of you guys out there are familiar with John Hyre, he is one of the top IRA and tax attorneys in our space. He has actually created this website. It has verbiage and summaries about the components of this bill. It has a really awesome 35-minute webinar that John recorded actually just about a week and a half ago. And not only that, but it has pre-written letters and templates that you can literally just copy and paste into an email or into a letter that you can send off to your representatives. Guys, this is serious. This could really potentially have a big impact, not just on Quest, but a lot of self-directed IRA investors, a lot of small businesses, multifamily complexes, even like self-storage units. A lot of those are funded by self-directed IRA investors. So the best shot that we have to hopefully put a stop to this thing or have some amendments made is to make as much noise as possible. It takes about 5 minutes to reach out. Please help us, help you, help the people, and the small businesses around you. This is definitely something really serious, but without further ado, let's go ahead and move right on it. I've said this in every presentation so far, but it feels really awkward to go from really serious legislation to upcoming events and educational opportunities that we have for you guys, but that's exactly how we're going to do it. So if you are looking for some self-directed IRA education, I would definitely encourage you guys to check out some of our other events that we have coming up. Now, we have officially brought back our in-person events here in Texas, in Houston, Austin, and Dallas. And we're bringing back the monthly mixers. They are now called the Self-Directed IRA Social. And this is actually kind of a change that we made this week, but we have just kind of opened up our classrooms a little bit more. We're not going to be as restricted, as spaced out. We're going to have more vendors, more attendees. So I'm really excited for this. If you guys are in Houston, Austin, or Dallas, check out our events page on our website. We have all of the information of the dates and the speaking topics for our self-directed IRA socials. But you can find us in Houston on the first Tuesday of the month, Austin on the second Tuesday of every month, and Dallas on the third Tuesday of every month. If you came to our events before the pandemic, you know that we host some really awesome parties and mixers in our offices. We would usually pack out the room with anywhere from 50 to 150 people, just depending on the night. So if you are ready to get back out there and you're ready to learn and network and have a few drinks and relax after work, come out and check out these events. You can find all of that information again on our website at questtrust.com. Just go to our events and you can find everything right there. Whoops, this slide got a little messed up here. But here's just some of our other webinars and events that we have going on for you guys. Again, you can find all of this information on our website. And if you want to rewatch today's class, as well as any of the other classes that we host here at Quest, you can find all of this information on our YouTube channel. You can find them on YouTube, Facebook. I prefer YouTube. It makes it a little bit easier to watch there. And I can see Logan in the chat right now. He's sending some links for you guys. So if y'all have any questions, just reach out to us. And be sure to mark your calendars. Okay, this is my last announcement before we really get into today's class. But be sure to mark your calendars. We have our next big online conference coming up on December 3rd and December 4th. It's coming up here in just about a month and a half. But this is going to be a bit of a larger scale event. It's actually a paid event. You do have to buy a ticket to attend, but we'll have about 20 different guest speakers over the course of 2 days. And this is QuestCon Live Forecasting 2022. So all of this 2 days of education will kind of be focusing on the market, where we're at now, how did we get to this point over the last year and a half, and where should we be looking to set our sights and our goals for 2022. So this should be a great event. I'm actually in the middle of curating all of our speakers and the lineup right now. So we should have that announced here in about the next couple of weeks. So be sure to keep an eye out for that and get your tickets right now. They are an early bird. So I hope you enjoyed those announcements, and I hope you guys are ready to really dive into health savings accounts. So we called this class today Health Savings Accounts, the triple threat of tax advantages, because health savings accounts, honestly, really have some cool features to them that have a lot of added advantages that the other accounts don't quite get. Now, most of our IRAs at Quest, they either grow tax deferred or they grow tax free. You have to wait until you're 59 and a half to take the money out. But the health savings account can actually be used to pay for any of your qualified health expenses for both you and potentially your immediate family and dependents as well. And one of the best things about HSAs is they can actually be self-directed, just like all of our other IRAs at Quest, but you can actually use the money today completely tax-free to pay for any of your qualified health expenses. So over about the next 30 to 45 minutes, we're really going to dive deep into these accounts. Again, if you guys have questions, put them in the Q&A box and I will be answering them at the end. I'm a little ADD, so it's a little hard for me to answer them throughout the middle of the presentation, but I do have Logan, one of our other IRA specialists. He is here online moderating today's webinar with me. So if you guys have any, really urgent questions or it's not health savings account related, he'll be online to kind of help answer those throughout the presentation as well. And once again, in case you forgot, within the last 5 minutes, we do have a disclaimer. This presentation is really just for educational purposes only. Without further ado, we'll go ahead and move right on. All right, so why is this even important? I thought this was a really interesting statistic here. And sorry, it's a little bit pixelated for you guys, but health expenses are a really big concern among pretty much all Americans out there. When it comes to Americans' top financial concerns, the ability or the non-ability to be able to pay for medical expenses in the event of a serious illness or accident, over half of Americans are significantly concerned about these expenses. Now, a lot of Americans out there are also living paycheck to paycheck. So if a serious medical concern comes up, a lot of times this could really put a lot of financial distress on you, on your family members. It could take you out of work for a while. So it's a kind of a really common theme that we like to teach about here at Quest is the things that you are doing today, the steps that you're taking now to save money, invest it, put it away, and let it grow so you can have more wealth, typically for retirement is what we're talking about. The same exact thing applies to your health expenses. So, you'll see here on the next couple of slides at Quest, we have 7 different types of accounts that can be self-directed. They all fit different needs, and the health savings part of it, the medical expenses, and, taking the right steps today to make sure that you have prepared yourself if and when these expenses come up is something that everyone out there should be thinking about. I think especially over this last year and a half with a global pandemic, it's something that's really important, probably more important now than ever, especially with those rising health costs, really just going up further and further throughout each year. So quick little overview of what we're going to cover today. I'm going to try to keep the first part of this presentation pretty quick, but we're going to do some self-directed IRA basics, and I'm going to try to get it done in 10 minutes so we can really focus in on the technicalities with those health savings accounts. Now, in all of our classes, we always like to talk about kind of the basics of self-directed IRAs. What is it? What types of investments you can hold? Because that really does lay the foundation. However, if you have not watched our basics class that really covers this in about a full 45 minutes to an hour, I would definitely recommend that you guys go back and watch that. If you have questions about where to find those links, just reach out to Logan there in the chat and he can kind of help to direct you in that direction. Now, what is a self-directed IRA? The main purpose of this slide here is really just to reiterate the fact that self-directed is honestly just a marketing term. The IRAs and all of the accounts that we hold here at Quest legally are exactly the same as any IRA or any HSA that you might have at any other custodian. The only difference is the types of assets that we allow you to hold in these types of accounts at Quest. So at most traditional custodians, we see a lot of HSAs at HSA Bank, Bank of America, TD Ameritrade, Fidelity. At these types of custodians, your accounts can only be invested into publicly traded assets, things like securities, mutual funds, the stock market, where at Quest, our platforms are set up specifically to allow you to hold privately held assets in these accounts. So just one kind of like final note here, self-directed, really just a marketing term. And when we say self-directed IRA, honestly, we're really referring to all of the types of accounts that can be held at Quest, not just IRAs, but health savings accounts and Coverdell education savings accounts as well. We kind of bundle them all together in this self-directed IRA term in a lot of our presentations that we give. Now, there are a lot of benefits to having a self-directed IRA, really going to breeze over this, but I personally think that having at least a base knowledge of how these self-directed accounts work, no matter who you are, no matter where you are in your real estate investment journey, saving for retirement, being active, being passive, or maybe starting with a lot, or maybe starting with, $5,000 in an account. There's a lot of different benefits here. There's a lot of reasons why you want to be prepared and educated with this information, because you never know when a right deal or conversation might come across your plate where a self-directed IRA or HSA might really make sense for this type of investment. So make sure that you're paying attention to this and that you're kind of keeping your eyes open to the options out there. But if you really want more of a breakdown of that slide there, go back and watch our basics presentation. That way we can really focus in on the HSAs in today's presentation. Now, again, we do have 7 different types of accounts that can be self-directed at Quest. The HSA does fall under these specialty plans where, you don't necessarily have to wait until you're 59 and a half to start taking these funds out and start using them. Now, with the traditional IRAs, the Roth IRAs, the employer plans, all of these plans, you have to wait until retirement to start taking the money out for personal use, which is why I personally think the Coverdell Education Savings Account and the Health Savings Account are 2 types of plans that everyone out there, if you have a need for it, should also be self-directing in addition to your true retirement plans. Now, the reality of this is most of our clients, they don't just have a health savings account or they have one just small Coverdell Education Savings account. Most of our clients will self-direct HSAs and ESAs in addition to their true retirement accounts, like the Roth IRA, the traditional IRA. And the reason behind this is a lot of times, a lot of our clients will like to partner these accounts together, especially, historically speaking, HSAs and ESAs typically are not the largest accounts out there. Most Americans hold their wealth in some sort of 401k or traditional IRA, or, maybe sometimes they've really started to build up that Roth IRA as well. But typically when someone's self-directing a health savings account, and you'll see the contribution limits on the next slide, and this kind of has a lot to do with that. A lot of times this isn't the only type of account you're self-directing. And since they usually start out somewhat small, a lot of our clients might choose to partner their multiple types of accounts together. Now you'll see here the vesting. This is really important. This is basically how any of your IRA investments will be titled. It'll always be titled Quest Trust Company for the benefit of, which we abbreviate FBO, your name, and then your IRA account number, or in this case, your HSA account number. Now, That's the titling if you're just using one account on the investment. Say your IRA is being a private lender, or your IRA is purchasing shares in a privately held company. That's how it would be titled. However, if you're partnering your accounts together, you just add this kind of little bit of extra onto the end. So you would title this investment, for example, Quest Trust Company for the benefit of your name and your IRA account number as to an undivided interest of blank percent. And then you would just list the other account, Quest Trust Company, for the benefit of your name and then your HSA account number, for example, if you're partnering your HSA. And in this example, we've used 50%, but honestly, this could be any percentage. I know personally for me, how I actually grew my small Roth IRA was I actually partnered it with my mom's Roth IRA for a couple of different fix and flips, a couple of pieces of real estate here in Houston that, she's been self-directing her IRA for much longer than I have. So my IRA literally owned 8 to 10% of 3 different investments over the course of the first few years. And just from owning those really small percentages of ownership, my IRA was able to between double and triple in value just within those first couple of years. We found some nice properties. Our IRAs were able to purchase them at a pretty low price. Then, about a year or two, whenever our IRAs sold them, my IRA got that percentage of the profit because it was partnered in on the deal. We see people do this with multiple types of accounts all the time. People do it with HSAs, ESAs, Roth IRAs, any of those 7 types of accounts that were on this previous screen. You can partner pretty much however you want to. There are some restrictions to be aware of, which I think we'll get into here on the next slide, but partnering, to sum it up here, is a fantastic tool to grow these smaller accounts that you might have between you and your immediate family. And yep, this is kind of a very, very summarized description of some of the restrictions that you need to be aware of when you're investing with these accounts. Basically, the golden rules of IRAs is your IRA was created with really great tax advantages to help you save for retirement, or for the health savings account case, to pay for qualified health expenses. The IRS has put some rules in place where basically you can't use your IRA to fund into your own business. You can't use your IRA to loan yourself money. Your IRA is really to benefit you in retirement and not today. Those same exact rules for disqualified people and prohibited transactions apply to health savings accounts in the exact same way that they apply to the other IRAs. So again, this is my only slide that I have on this, really just for time purposes. I don't really want to get too bogged down in this information, but go back and watch our basics or our foundations of self-directed IRAs class. And we really kind of break it down much further into those rules, what you can and can't do. And honestly, if all else fails, all you have to do is pick up the phone and call an IRA specialist, or visit our website and just send us a chat. We've got a live chat feature. It's a real IRA specialist on the other end of that chat. If you log in on Mondays, for example, you'll get me on that chat answering all of your questions for you. But just give us a call if you have questions. We can always answer those for you to let you know if something is allowed, if it isn't allowed, or maybe if you might find yourself dancing in a bit of a gray area there. Now, moving right along to the health savings accounts, this is just an interesting chart, and this wasn't even updated in the last couple of years. This is the trends and projections in U.S. healthcare costs all the way up to 2021. And this chart right here, I'm pretty sure was before COVID. So guys, saving for your health expenses, preparing for the unexpected is extremely important and can really help to add a nice cushion and layer of security to both you and your immediate family. Unexpected health costs are actually one of the number one reasons for bankruptcy in Americans in the United States. So just kind of looking at this chart here, you can see how expensive healthcare is getting. And kind of like taxes, we don't know what's going to happen in the future, but it's probably going to go up. So just to kind of reiterate how important this is, and something that I always kind of like to stress in these classes as well, is everyone has to start somewhere when it comes to saving for retirement, when it comes to investing in real estate, or in this case, saving for potential health expenses in the future. You're never going to be able to get to your goal if you don't start today. So get it started, get some money put in there, create some goals for yourself, create some timelines. That way, when these expenses come up or when you're ready to retire in the future and not work until you're, 70 or 80 years old, just so you can afford to live, you've taken the right steps today, and 5, 10, or 20 years from now, you're going to be really happy that you started today and you didn't just wait because, it's easier to wait than, take the time to go ahead and get it started and get that money working and get it invested. And these are just a few more statistics here. From May 2017 Federal Reserve press release, 44% of Americans could not pay an unexpected $400 medical expense. Guys, that is crazy. You'll learn here in my next couple of slides, just by making a contribution to a health savings account, you can actually get a tax deduction on that contribution, and that could easily cover your $400 medical expense. But if anyone here has been to the doctor recently, depending on, what type of health insurance or what type of doctor you're needing to see, $400 is just a drop in the bucket when it comes to medical expenses. And 25% of Americans reported skipping medical treatments due to cost. Guys, I've actually done this myself. I fell walking my dog a couple of weeks ago. My hand is still swollen, and I did not go to a doctor because I didn't want to pay $3,000 to $4,000 to help them tell me my wrist was sprained. So I'm not the only one doing this out there, but it is important to realize that at some point, if the medical expense is unexpected enough, or if it's serious enough, you're going to have to go to the doctor, and you're going to have to make sure that you are prepared for this cost. Now, what is a health savings account? Health savings accounts were actually created in 2003. So all things considered, when it comes to these tax advantaged accounts that we have, they're one of the newer ones out there. They were created specifically to help Americans save and pay for medical expenses. And one of the biggest benefits of a health savings account is that it is not a use it or lose it plan. Every year when you invest and you grow your HSA and you're building up money in this account, the money rolls over from year to year. There's not even any required minimum distributions whenever you get older. So the funds can be rolled over from year to year. So it's a really great account to go ahead and start saving, start investing, and start making those regular contributions each year. And here's what we all want to know here. Why is this the triple threat? So HSAs, we kind of like to call it the best of both worlds. This presentation calls it the triple threat or the triple benefit. Either way, I think it's pretty clear that this account has multiple different advantages. It is the only account that we offer that can be self-directed, that when you make contributions, they are tax deductible. You can invest and grow the account. It can be self-directed, just like all of our other IRAs here at Quest. And then whenever you take your distributions, as long as they are either to reimburse yourself for qualified medical expenses or to pay for qualified medical expenses, the distributions come out completely tax-free. It's the only account that you get the tax deduction when you put the money in, and it comes out completely tax-free. All of the other accounts, it's either one or the other. You either get the tax deduction and then you have to pay taxes later, or you pay taxes up front and then it grows tax-free. But if you really kind of learn how to work the health savings account, if you understand the rules and how it can be utilized, this honestly can be one of the best accounts that can be self-directed, because it kind of gives you a lot of flexibility in self-directing it, growing it tax-free, getting those tax deductions. And once again, you don't have to wait until you're 59 and a half to get the money tax-free. So I hope this makes you guys excited. It definitely makes me excited kind of as I go through and I talk about this, if you can't tell. But it is really important to be aware that there are some qualifications that you have to meet in order to be eligible to make contributions to a health savings account. That's actually something that this title should clarify a little bit better, because the way that this title is written is not actually 100% correct. And I'll let you know why in a second. The 3 qualifications that you have to meet in order to be eligible to make contributions to a health savings account. The biggest one that will typically determine if someone is eligible or not is you have to have a high deductible health plan. Now, for 2021, the definition of a high deductible health plan, if it's an individual covered on the health plan, it is a $1,400 deductible. And I'm looking down because I just looked up these updated numbers just before this presentation. So it's $1,400 deductible if it's just you on the health plan. And if it's you and maybe a spouse, or maybe you and your family, or you and dependents covered on your health plan, the high deductible kind of point that you have to hit is a $2,800 deductible. You can find all of this information online. It's a quick Google search away if you ever forget. And honestly, that's how I always stay up to date, because these numbers kind of do slightly change every year for multiple different types of accounts. So you have to have a high deductible health plan. This is the way that your health plan will be classified. And you cannot be enrolled in Medicare, and you cannot be claimed as a dependent on someone else's tax return. Now, as long as you meet these 3 qualifications, you are eligible to make contributions to a health savings account. But let's kind of put it into like real world example for a second. Say I have my job at Quest, I have my high deductible health plan, which I actually do. And so with that, I have a health savings account. I actually have an HSA at Quest, and I have one at Bank of America that gets automatic deposits from Quest every month, which is really awesome that they do that for us. But say I quit my job, say I become a full-time investor. So I have money in my HSA, but I'm no longer covered on my high deductible health plan. What happens with the HSA? You only have to meet these 3 qualifications in order to make contributions to the account. So if I no longer have a high deductible health plan, I can still keep my HSA, I can still invest it, I can still grow it, and I can still use those distributions for my qualified medical expenses. The only thing I can't do anymore is I can no longer make any new contributions to that account. So we see this happen a lot. Sometimes when people get a little bit older, they get enrolled in Medicare, or, someone leaves a job and they no longer have that high deductible health plan anymore. At that point, you don't lose your HSA. You don't have to take the money out. You're not penalized in any way. You can just no longer make any new contributions into that account. And moving right along, here are the contributions for both 2021 and 2022. Now, HSA contributions are one of those, they pretty steadily, they raise the contribution limits by about $50 to $100 each year. They give you a whole extra $50 to, hopefully get yourself enough money in there to be able to pay for your medical expenses. But the contribution limits to this account, it's a little bit different than the other IRAs that we have, because the amount that you can contribute is based on who is covered on your health plan. So if it's just you, an individual covered on your high deductible health plan for your medical insurance, you can contribute for 2021, $3,600. Or if it's you and dependents, or you and your family, for 2021, you can contribute $7,200. So they basically double it. And if you're over the age of 55, you get an extra $1,000 catch up to hopefully get caught up and have enough money to pay for those medical expenses. Now, for 2021, you can make contributions up until the tax filing deadline, so April 15th of next year. And remember, these contributions are tax deductible. So even if you just open up an HSA, you make your contribution, and you immediately take the money out to go to the doctor or go to the dentist, you've still gotten a really big benefit there because that contribution was tax deductible. Now, for 2022, you are not able to start making this contribution until January 1st of next year. But something that I think is really kind of interesting with health savings accounts, is something kind of in this last bullet point here that's called the last month rule. Basically, with this, as long as you are covered on a high deductible health plan by December 1st, it's basically counted as if you've been on this plan the entire year and you can max out your full contribution. As long as you have that high deductible health plan in place by December 1st, it's like you've been covered for the entire year. Now, it's a little bit opposite. Say, in that previous example, I work at Quest, I have my HDHP, and say I quit my job in June. Since I was only covered on my high deductible health plan, assuming I'm cut off as soon as I quit my job, say I'm only covered up until June, I would be able to contribute, about 50% of that annual contribution because I was not covered on that health plan for the entire year. It's a little deep into the weeds there, but I think it's kind of interesting and important to touch on there because depending on when your company or when your health insurance has open enrollment, that will typically determine when you're able to actually maybe switch your health plan so you are now eligible for an HSA. And what can you pay for? Guys, honestly, this is very, very broad. You can pay for doctor visits, vision, dental, medications, chiropractor, hospitalizations, ambulance expenses. Guys, long story, rode in an ambulance one time and we got a bill for about $10,000 just for a 5-minute ride through downtown Houston. It was ridiculous. I'm not sure what really ever ended up happening with that, but there's a lot of medical expenses that can be paid for with health savings accounts. If you want some nice, light, fun reading there, check out IRS Publication 502. They've got the full list of all of the different health expenses that can be covered with an HSA. Now, there is a very small list of things that cannot be covered by health savings accounts. Plastic surgery for cosmetic purposes, medical marijuana, funeral, maternity clothes, teeth whitening, vet fees. Unfortunately, can't pay for those vet bills with an HSA. But the list of the things that you can pay for is much larger than the things that you can't pay for. So again, IRS Publication 502 lists all of that out for you. And as always, if you have questions about the specifics of this, just reach out to an IRA specialist and we can kind of walk you through that as well. Now, let's talk some technicalities a little bit because this is a really common question that we get at Quest. Most traditional HSAs out there where you might have through Bank of America or, HSA Bank is a really large one. They actually give you like an HSA debit card that you can take to the doctor with you, you can use for your medical expenses. And a really common question that we get at Quest is like, okay, so if I have my HSA with you guys, do I get my debit card? How do I pay for these expenses? How do I prove to you guys that I paid for a medical expense there? And to be completely honest, it's pretty simple on our end. Quest will never need to see your medical receipts or what you're using the distributions for. Remember, Quest is a neutral third party. We're just the custodian, and you as the IRA account holder, or the HSA account holder in this place, it's up to you to make sure that you keep proper records in place for these health expenses that you're paying for with your HSA distributions. So we don't necessarily have a debit card that you can use, but really, it's really simple. All you do is you fill out a distribution form. You can fill it out completely online, and we'll basically send you that distribution in a check, ACH, or wire in about 24 to 48 hours. And again, you'll never have to send your receipts to Quest, but you do want to make sure that you are keeping proper records of the expenses that you're paying for your medical expenses and the distributions that you're taking from your HSA. Because if you ever were to get audited by the IRS and they're like, hey, Bob, what did you use this $10,000 HSA distribution for? You would want to be able to show that, okay, I went to the dentist 5 times this year, 5 times. I went to the doctor, I had a broken leg, I had some chiropractor visits, and I have all these receipts to kind of back up what I was taking these distributions for. Now, let's see, I think I've hit all the bullet points there. Yes. And something that's really important here is that the HSA has to be in place at the time that a medical expense occurs. So if I did not start my HSA until this year and I had $10,000 worth of medical expenses last year, I wouldn't be able to use my HSA to pay for those medical expenses because my HSA was not in place at the time that that health expense occurred. However, as long as the HSA is in place at the time that you incur a health or medical expense, you can come back months or even years down the line and reimburse yourself completely tax-free from your HSA because technically it's a reimbursement for that medical expense that you had paid for out of pocket. And we'll kind of apply this here in one of my upcoming case studies. It's actually one of my favorites that we really go through in any of our presentations. But here's a nice little chart here of some of the common types of, health type of accounts that a lot of Americans have out there. We see a lot of flexible spending accounts, FSAs, health reimbursement arrangements, HRAs, or last but not least, the ones that we have at Quest is the HSA. Now, there's kind of some bullet points here. It's kind of interesting. The HSA does have the largest contribution limits, and these are actually the old ones here that did not get updated before today, but it's very close to what they are now. But what I really want to focus on here, and I'm not sure if you guys can even see my mouse or not, but kind of here towards the bottom, contributions can be tax deductible and the distributions come out tax-free. It's the only account, even on this screen, that gets both of those benefits. And it is the only account that 100% for sure the funds roll over from year to year. The flexible spending account is kind of anything but flexible because it's a use it or lose it. If you don't use that money by the end of the year, you lose it. But you don't have that with the HSA. So it's a really great way to invest, grow that money, kind of just get it working and earning income from year to year and kind of build it up so you can start reimbursing yourself for your qualified health expenses. It is also the only account that you have the ability to self-direct out of the three on this screen here. And last but not least, say if you have an HSA and you leave that job, the other two accounts on this screen, there's no portability. You don't have the ability to move those funds. Not only do you lose it at the end of the year, but if you leave that job, you lose it as well. So I don't know, to me, there's kind of a clear answer here as far as which one is definitely the most flexible for you. And it's the health savings account. And it's one of the reasons why we love to host this class here to really kind of dive into these details and differences. One other detail I do want to touch on here is, a lot of times people might have an HSA that's linked through their employer. I know at Quest, Quest will actually make contributions to our HSA each month for us, a kind of small nominal amount that they're putting in for each employee. Unlike a 401k, where while I'm working at Quest, I cannot move my 401k into an IRA. I'm not eligible to do that while I'm still working here. But an HSA, even if my employer is making contributions, I don't have to leave it in that account. Even while I'm working at Quest, and Quest kind of makes my contributions to my Bank of America HSA, about every quarter or so, I take a good chunk of that money and I actually transfer it to my HSA at Quest so I can kind of partner it in with my Roth IRA and start doing those deals and have my money kind of moving around and diversified kind of based on where I'm wanting to use it. So that's kind of another big important point to hit there. Now, this slide here, we've got Nathan, the president of Quest Trust Company. For those of you guys who don't know Nathan, he's actually a pilot. I don't know if he still owns it, but at one point he owned an airplane. And this right here is a really cool case study, and it kind of shows the flexibility and the freedom that you have with health savings accounts if you understand how to really work and utilize these accounts. So, and this is the only slide I have for this, so you guys are just going to have to look at his face for a while. But several years ago, Nathan's wife at the time, she had to have pretty major dental reconstructive surgery. This dental reconstructive surgery was to the tune of about $30,000. Now, For most people out there, when you start an HSA or you start making your $7,000 contribution each year, if that health expense occurs, you don't really have that money built up yet in your HSA to immediately pay for that expense. But what Nathan did in this case was he actually had his HSA in place. It was kind of small. He was investing it, he was growing it. And then when his wife incurred this $30,000 medical expense, they had to pay for that out of pocket. So what did Nathan do? They paid for that expense out of pocket. He kept his receipts. And what he did was he continued to invest and grow his HSA over about the next, I think, like 6 to 7, maybe 8 years. Over the course of that time, he was able to do some creative investments within that HSA. Obviously, being one of the owners of Quest Trust Company, you really understand those strategies that you can utilize to grow these small accounts. And years later, Nathan got a random itch and decided he wanted to buy an airplane engine. This airplane engine also just so happened to cost around $30,000. So what did Nathan do? At this point, he had built up his HSA and he took a $30,000 distribution from his health savings account completely tax-free. Why was it tax-free? Because he was using it to reimburse himself for a medical expense that he had previously paid out of pocket. Since he had paid for that health expense out of pocket when he had an HSA in place, he was able to come back years later and take that $30,000 distribution completely tax-free. Even if he was nowhere near 59 and a half, that distribution came out tax-free because it was a reimbursement for a qualified medical expense that had happened, just a couple of years in the past. But what did he do with that? He bought an airplane engine. So how can you buy an airplane engine or maybe whatever else you want to buy with completely tax-free dollars that have been self-directed, even if you are nowhere near 59 and a half? A health savings account can be a really, really great way to do that. And it's actually what I'm doing now, which kind of leads you into my story. Here's me in Seattle. I figure Nathan had his airplane. I'd put myself with a nice little sculpture, some sightseeing there. But, my story is a little bit different from Nathan's. It's much more on the newer end of things. But at Quest, when I started working at Quest, I didn't really know which health plan to go with. I either had the option to go with the PPO plan, which is what Nathan calls the big boy plan. It covers every health expense. It's got a low deductible. It covers a lot of things. Or I could have gone with a high deductible health plan, which would have included a health savings account that, basically as an employer, it is cheaper to insure your employees on a high deductible health plan. So when Quest insured me on a PPO plan, I wasn't eligible for an HSA. But a couple of years later, once I had learned a little bit more and I had heard this airplane story probably about 200 times, and I was like, all right, I got to get on this myself. I actually switched from the PPO plan, the big boy plan, as Nathan likes to call it, over to the high deductible health plan, where my deductible is a little bit higher. Some of my medications I take are a little bit more expensive, but since I'm paying for these medical expenses, the difference that it cost Quest to now insure me on a high deductible health plan, they actually contribute that difference to my HSA. Now, not every employer does this. Quest is a fantastic company, especially through the pandemic. They've really taken care of all of their employees, but not to get too, into the weeds there. But I decided I would now want to, bite the bullet a little bit, pay a little bit more for my medications. And now I have money building up in my HSA that Quest is contributing. I'm contributing as well. And I've kind of done the math. So by the end of this year, I will have maxed out my $3,200 between Quest contributions and my contributions to this account. And my next private lending that I deal, I'm actually going to partner my Roth IRA, my HSA, and my boyfriend, who obviously has his IRAs at Quest as well, because he's learned from the best. We're going to start partnering all of these accounts together and do more private lending deals. And I'm really excited. Maybe when I teach this class in the next couple of months, I'll have a real case study to put here for you guys. But, to figure out if you should have, the kind of PPO plan, the one that's built in a little bit more, the higher premiums, the lower deductibles, or if it makes sense for you to maybe have a high deductible health plan with higher deductibles, lower premiums, and the option to have an HSA. It really kind of depends on how often do you see the doctor? How good is your health? If you have a lot of either health problems or, ongoing issues or anything like that, where you're seeing the doctor a lot, it might not make sense to have the high deductible health plan because you're going to have that higher deductible, and you might be to the doctor. But if you are in good health, if your family that's covered on your health plan is in good health, you guys don't go to the doctor very often. If you look online, you can see more detailed comparisons of, should you go with one type of plan or the other. But there are definitely some things that you want to consider there. The high deductible health plan is not for everyone, but one of the biggest benefits of having this plan is that you do get the HSA that goes along with it. And that's exactly why I switched here just a couple of years ago. All right, so kind of to wrap it up, some more just random miscellaneous fun facts here on this account. This is a really cool one here. One time in your life, you can actually fund your HSA up to the contribution limits of that year from your traditional IRA. And this is really cool for a couple of reasons. One, if you're looking to fund your HSA and you maybe don't just have a lot of extra funds sitting in your checking account, but if you have a traditional IRA, one time in your life, you can take that, up to the contribution limits from your traditional IRA, move them into the HSA at Quest. It's literally a one-page internal transfer form that you fill out. And now you have money in your HSA that you can start investing and growing and using for your qualified medical expenses. Another reason this can be really beneficial is because, say, if I have a $3,000 health expense this year, and I just don't have the money to pay for this, I'm in a bind, all of my money is in my traditional IRA. But if I take that distribution directly from my traditional IRA, I'm going to be taxed and I'm going to be penalized. Or I can take that $3,000 from my traditional IRA, fund my HSA with that money. There's no cost to do that. There's no penalty, no taxes. And now that it's in my HSA, I can immediately take it out as a distribution, tax-free, to pay for my $3,000 medical expense. Now, you can only do this one time in your life, but this could be really beneficial to certain individuals out there that might have this particular need. You can pay for prior year medical expenses as long as you incurred the expense while the HSA was in place. Already covered that one. If you use an HSA to pay for a non-qualified medical expense, there's a penalty there. It's a 20% penalty and it's taxable unless you are disabled. And this next one I've already covered here as well. You can still use your HSA even if you are no longer eligible to make those contributions. I think that is huge because especially, this past year, a lot of us have moved jobs. A lot of us got laid off at the beginning of the pandemic. A lot of us are, getting promotions and moving up, kind of in the corporate world. So if you have an HSA and you move a job, you don't necessarily lose it. I think that's something that's really valuable there. And after age 65, your HSA actually becomes very similar to a traditional IRA, and non-medical distributions would still be taxable as ordinary income. However, they are no longer penalized. And what happens to your HSA when you pass away? The rules for this one are a little bit different than normal, just inherited IRAs. If it's a spousal beneficiary, they can either take it as their own HSA or, just take it out as distributions. If it is a non-spousal beneficiary, the HSA funds must be distributed. You can't necessarily have an inherited HSA per se. It would be taxable, but there's no 20% penalty. But what the beneficiary could do in this case is they could use the HSA to pay for medical expenses for the account holder up to 12 months after their death. So if that account holder had some, end of life, really high medical expenses, I know sometimes that happens out there, or, if they had medical expenses that they had previously not reimbursed themselves for, if you're able to track all of that down, you have up to 12 months to still take the money out tax-free, figure out what can be reimbursed for a medical expense, and then anything in addition to that is just taxable as ordinary income. And COVID-19 and the CARES Act, since COVID-19 was kind of a new thing this year in the CARES Act, they did determine that high deductible health plans can cover COVID-19 costs. I'm not going to spend too long on this one, but if you guys want more information, some more light reading, we have IRS publication 969 and IRA publication 502. That covers a lot of great information there. You can Google those. And I'm sure probably not many of you guys know this, but the reason we actually hosted this class today is tomorrow is actually HSA Day. Whoops. All right, this one might have a timer on it. Tomorrow is HSA Day. So for today and tomorrow, we are actually waiving account opening fees on all new health savings accounts that are opened up at Quest. Logan, if you can drop your email in there, guys, if you're interested in opening up an HSA, it takes about 10 minutes. You can do it completely online. It's great to get started. It's great to partner. If you have questions, we can walk you through it. We always like to go through a full one-on-one consultation before we actually open up these accounts for you. But this is kind of a flash sale. It's kind of a quick one. It'll be gone and done by the end of the day tomorrow, October 15th on Friday. So that promo code is HSA21. We kept it really simple for you guys. And I hope this class kind of fired you up, maybe got you excited. I hope you learned a couple things about health savings accounts. And just to kind of wrap it up here, at Quest, we host a lot of education. Our goal is to help you build wealth, help you understand how to utilize these types of accounts and be successful so you can actually become financially free and have true control over where your tax advantage money is invested. We don't have much control over the stock market. We don't have much control over taxes in the future. But what we do have control over is where we choose to invest our funds and who we choose to work with for that. So I personally think Quest is a great company to not only work for, it's a great company to work with. A lot of our staff are investors ourselves, and a lot of us have been with Quest for several years. So our goal is to help you learn how to really understand these types of accounts, understand what you're doing, and really kind of help you be successful along the way. This is my last slide here, guys. I hope you enjoyed today's presentation. If you have questions, reach out to us. Let me check the Q&A. I honestly don't think I saw any questions come through. Logan, it looks like you did get a few of them answered there that weren't really related to HSAs. So thanks for go ahead and answering those. But since we don't have any questions, sounds like you guys should all be experts. You guys should all be opening up HSAs at this point. Just kidding, a little bit of a joke there, but reach out to us. We're always happy to help. Give us a call, schedule a consultation through Calendly. You can chat live with us directly online through our website. And remember, please take a few minutes as soon as possible to reach out to your representatives. That new legislation has not been voted on yet. They keep pushing back the vote, which hopefully for us is a good sign. It gives us more opportunity to reach out and show them that there's a lot of people out there that oppose this legislation. And so take a few minutes, reach out. Remember that website is handsoffmyira.com. And that's all I've got for you guys. I hope you enjoyed it. And we'll see you at our next webinar. We'll see you at the next virtual happy hour. And I hope you all have a great day and a great weekend.